All right, as promised, going back across now to market expert Ajay Bagga. If you can hear me now, what we were basically discussing earlier on was your reaction, first of all, to the Sensex crashing over 1,000 points, reflecting a broader pullback in the global stocks and what that really would mean.
Yeah, India is getting hit more by the global market sell-off. We saw on Friday that there was a very strong US jobs report. What that led to was a recalibration of the market expectations of Fed rate cuts, how fast and how much would the Fed cut rates this year? That was the big question. And mostly analysts have now factored in one rate cut, if at all. There are some who are talking about rate hikes being the next move from the Fed rather than cuts. What that led to was higher bond yields in the US, a stronger US dollar. That is in turn leading to higher bond yields across the world. And rising yields are not good for stocks. So we are in a lose-lose situation in the markets because the strong US economy means a strong dollar, strong US rates, and that's not good for the global markets. And Fed will not cut in that kind of a scenario. But if this situation changes to a weak US economy, which will mean weak corporate earnings at very elevated valuations for the US market, that could bring a sell-off to the rest of the globe as well. So that's why we are in a lose-lose situation with risk of being the predominant sentiment in the markets. And India is facing its fair share of that. We are seeing FI outflows. We are seeing a domestic economy which is slowing down. We are seeing muted corporate earnings growth, a falling rupee, and the dollar strength. And despite the dollar strength, we are seeing the oil prices going up on the Russian sanctions. So these are the factors behind the sell-off in the Indian markets. And these are, mid-term kind of or medium-term kind of factors. So not very easy to address them until the global overhang goes away from the Indian markets.
Right. Speaking of which, what is your outlook for Indian stocks?
Right now, we are very cautious. I think the mid-cap and the small caps are seeing the brunt of selling. They had higher valuations and they have outperformed for the last 2 years. So we are seeing money going off the table. As far as large caps go, the fall has been higher so far, but today we saw the mid-cap, small-cap indices falling much sharper, much more sharply. So I think there's more pain on the mid-cap, small caps. The large caps are reaching levels which make them quite interesting. But the main concern is when does the global overhang go? So does it go away with Mr. Trump's inauguration next week? And then within a week of that, we will see all the executive orders coming in and we'll get an idea of his tariff plans, of his inflation impact, of his impact on the global bond yields. Right now, it's totally risk off and everybody's reducing their exposure in the risk markets. That's what we are getting hit with. So the first catalyst really will be Mr. Trump's inauguration and the early actions of his government. So it could take about a month at least for the Indian markets to see some kind of a recovery. Two other big factors coming up in February. First, the union budget and then the RBI meeting. Now, the RBI Monetary Policy Committee meeting will have its hands tied because of the sharp fall in the rupee. So can they cut rates in that kind of a scenario? That's the big question. We need a rate cut to help the economy, to provide some stimulus to the economy, which is slowing down. And the monetary policy has been very restrictive. Domestic liquidity has been very tight. So we would need a CRR cut to inject more liquidity into the domestic economy. But when you start cutting rates, the rupee weakens further. So that will be at the back of the RBI's mind, and they will wait for the union budget to see how is the government containing the fiscal deficit, what kind of expenditure and revenue prognosis the government is going to give. And then on 5th to 7th,
Right.
the RBI MPC meets.
Right. We're leaving it there for the moment. Thanks very much for joining us on the broadcast here.